And I hope everybody can hear me good. You can hear me good, right?
Yes.
Okay. So the first question we had before we get started was on work history. Whether work history has to be a minimum of 2 years unconditionally, or is there any exceptions? And what I was explaining is there is the exception is the following. If you are going to school for graduation of a certain career, for example, nursing or anything specific, and when you graduate, your position starts in the industry that you took, automatically, you are automatically qualified for financing based on your new income. So that's a huge thing because, you know, they may have a work history before they started school that had very little income, but you don't have to average, you don't have to do anything. If they're now making $40 an hour because they're a nurse and they just started last month, and we can show that they were in school for that, you automatically qualify using the $40 an hour, which is fantastic. You know, what you're going to have a little bit of a problem with is if you want to use overtime or bonuses, because in order to use those, the calculation requires us to have over 12 months. So maybe not the full 2 years, but over 12 months in order to calculate it. So if they have it and they're relying on their overtime to qualify, that's where it could get a little tricky. But according to their base pay, from the day they start their job, we can use that. You can use that income.
For the Hometown Hero program, is the same?
Yes, because Hometown Heroes attached, the first mortgage is a traditional FHA or convention. So it's a traditional loan in every sense. It's the second that comes in to help, right? And I know it's confusing because the interest rate is dictated by the state and all of that, but the actual loan, the actual first mortgage is either a traditional FHA or a traditional conventional. Yeah, it works the same as long as we can get an approval through our system, it'll be fine. Yeah, the person must already be certified. They couldn't have just graduated. Okay, they have to have certification from the state of Florida.
Oh.
Yeah. So that's another important thing for at least until July, because that's going to go away in July 1st, which we'll talk about a little bit. Until July, we still have to have a certification from the state of Florida. And there's a bunch of different websites you can go on and to look at the certifications. You know, sometimes the person themselves don't have to be certified. For example, if they work at a school or a daycare that has a school curriculum, you know, like those advanced daycares, and somebody works there and they may not be a certified teacher, but if the school itself is certified, we can piggyback off that license too between now and July. But that's going to go away very soon. So luckily they, you know, changed their mind and they added a lot more money.
The social workers in the school?
A social worker at a school, if it's a social worker, I would have to find out because that's not in the teaching capacity. That's more of a counselor. I think they might need some sort of certification for that. I can't guarantee, but I'm thinking more of like, you know, if you're a teacher at a daycare and you actually have some sort of curriculum, like you do the ABCs with them and all that, and the school is certified to do that by the state of Florida. Yeah, and there are different categories. The state of Florida does have some daycares are actually considered educational centers. So if that license is certified and it falls in that category, and we can find it on the website, even though the employee themselves is not certified, they still qualify for the down payment assistance, you know, and it's a big deal. I did 2 sisters that everywhere else was like, no, 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 no. And we emailed the state of Florida. We asked the director and we were able to find the license of the place where they were working, and they were able to buy their house together that had they not, there was no way they would have been able to. Because their income level was so low that, you know, having $35,000 to buy a house right now is really difficult. You know, that's the biggest challenge is the money. So eliminating that's going to be a great thing. So that was a really good question. Okay, so I'm going to go ahead and get started with our specific training for today. I kind of wanted to talk in depth and see if you guys have any questions regarding how credit impacts a buyer and what kind of things we can do to put every single person you talk to into a home buyer's path. Okay, and that means that can we immediately fix their credit? through actually doing it directly through Credco, which is one of our specific vendors that goes directly to the credit bureaus and gives them an exact scenario of what we would need to do to fix the credit instantly. Or do we need 30 to 90 days to explore their credit again? Why? Because the credit drives everything. Let's start with the basics. Your score for an FHA loan starts at 500. I don't know if anybody knows that. Yes, 500, at 500. The caveat is that at 500, I need 10% down. But now with this new help that's coming, that's a lot more possible, right? So there's a lot of things that you can kind of work with. So you start at 500 with 10% down. Anything less than 10% down. So if your LTV goes to 95 or to 96.5, right? That becomes a 580 minimum. That's only for financing. So you need a 500 for 10% down. So if your borrower has the money, or you can get a 10% down FHA allows you to borrow, allows you to get from the seller 6% contribution. So if you have a borrower that's getting 6% contribution and you're doing 10% down, in theory, they're buying the house with 4%, right? So this is a way to kind of work into those lower credit score people. But that is a person that will not be able to get the assistance because the assistance start at 640. And that's where it becomes like, okay, but I can get the loan, but then I can't get the help. And if you get the help, sometimes you're limited on the sales price. You know, those are all of the moving parts why credit is so important. And what I want you to think about credit is, in every sense of the word, we should always be improving it. That's what builds loyalty with the customer. That's why I'm so passionate and I talk more about credit than I do about mortgages, right? Because if you're able to connect with somebody and change their life and they've hit the wall over and over again, they have those 2 little credit cards and they max them out and their score is always low, but they're not necessarily paying anything late and they just can't get to that home ownership. Your education to them is what builds the loyalty, and that's the one that's going to get you at every barbecue or party they go to. No, you got to talk to my people because they're the ones that got me there, right? And this is what I mean. Let's say a person has a 640 and can get the down payment assistance and all of that. We'll worry about the down payment assistance in a second. At 640, you don't get the same interest rate that you get at 680, right? And you're not going to get the same interest rate that you get at 700 or at 720. So imagine if you take a borrower that starts at 640, and while we're doing their application, and this is the real magic of Loan Depot, while we're in the process of doing the application, I lock the loan early with their poor credit. When you lock a loan, and a lot of realtors don't know this, when you lock a loan, what you're locking is the price of the day.
Yeah.
You are not locking the entire, the loan where it cannot change. So what happens is on that day for 640, your interest rate was 6%, right? But during the process of the transaction, I do my what if, and I try to do it on every single borrower. I see I can get them to 700. In the process, their loan is already locked, so I'm not taking any risk. I get them to 700. The loan is repriced on that day's pricing based on the new 700 score. I can drop the rate by 0.5 point and eliminate discount points. That's the power of working with a credit-based knowledge. So it's not just making a buyer out of somebody who's not a buyer. It's about constantly reinforcing that you have control over their finances. You're helping them become something. You're helping them get the lowest because they're going to follow your advice. And what I do with the what if, I first send it to the realtor, right? And it has information on there, but the information does not have social or anything. So I send it to the realtor and then I ask, do you want to approach it with the borrower together, or do you want to talk to the borrower about, listen, why don't you take these actions and see if you can get your credit up? Okay. Hi. See, more people. Hello. Bye. Figured you were just, kind of listening in. I didn't know you were actually going to hear. I'm sorry. Should have said something. So thank you guys. More people. So yeah, I always work with the credit profile, and I want you to start thinking along those lines. Make sure that you're constantly asking them about their credit. When you start working with them, 2 things you need to emphasize is try to bring down your balances. Okay, and how do you do that? Is the easiest thing you can do is stop using the credit card for the next 30 to 45 days. So that way you don't accidentally put $340 from Publix because you went grocery shopping, which you're supposed to do. And all of a sudden, that's the day that your credit card cuts the statement and reports to the bureau. That could affect your score in the other direction. So best practice, the moment you start talking with them is, do not use your credit cards for the next 30 to 45 days. Just work with your cash flow. And that alone brings down the balances slowly, right? If they have a little bit of surplus, not every borrower is completely strapped of cash. If you have like a $50,000 borrower and we only need 37 to close, well, maybe there's a couple things we can bring down. And that's what the what if would give you, right? So with the what if, you determine if you want to talk to the borrower by yourself or if you want to do it with us. And we do a three-way call and we start strategizing a plan. So that's in the good scenario where the borrower is already a working borrower. Let's say you get somebody who has a 520 credit score or 540 credit score. They don't qualify for FHA, they don't qualify for conventional. They would if they had the 10%, right? But if you have a score of 580, of less than 580, you probably don't have the savings in the bank. It just goes one with the other because, you know, why would you pay your car late?
Yeah.
There are situations where people have identity theft, right? So you've always got to ask. They lent their credit to their daughter for a car and they didn't get paid, things of that nature. So we can try and resolve some of those issues. But most impactful thing, and this is the next screen, most impactful thing is the breakdown on the credit. And I'm going to send you guys this.
I'm not seeing your, oh, there we go.
Yeah, I'm going to send you this so that you have it and you study it and you know it. Every single time you talk to a borrower, these are their questions. These are their questions regarding their credit. So payment factor, that's a big deal. Please don't pay anything late until we close. After we close, you know, hopefully you still don't pay anything late, but especially not the mortgage I just gave you, but don't pay anything late. That's a big one. And you have no idea how many people actually fall into trouble while they're in the process. They actually, for some reason, forget one payment, forget another. This is the time for you to take control. And what I mean about control is right there in front of you. I need you to download a credit app. And there's a bunch of free ones. Credit Karma, Experian has a free version, all of them. They need to monitor their credit the moment they meet with a realtor. They need to know who they are and what their capacity is. They should have a credit app in front of them. Because what's going to happen is you're going to find 2-3 weeks into the process, they're going to call you and say, oh my God, it jumped up 40 points. And that's when you call me and we get their interest rate down. Okay. Is it working? Is everything good?
Yeah.
Oh, okay. So please, let's make sure that we control the payment history and that we work towards bringing down balances, amounts owed. Where is the biggest impact on amounts owed? Anybody have any idea? Online or here? Anybody? What is the biggest impact on amount owed?
Cars thing? No?
No. Revolving credit. So if you are the type of person, because I am, every time I have a loan of any kind, whether it be student loan, car loan, whatever, I personally choose to pay 125% of the debt. I've done this my entire life and I bring down the balance that way. And the only help you're going to get when you pay down on loans is your obligation goes away. Because if you have a 10-year, let's say a 6-year car loan and you overpay, you'll see that when you get your next statement that your payment will either be less or you won't owe because they want you to consume the interest. They want you to pay them the interest. So it starts to erode. And that's the only benefit you're going to get. It does not have a huge impact on credit score, right? So very important feature is don't pay down on your loans. Leave your student loans, pay the absolute minimum. If you're overpaying on your car, stop and let's take that money and put it into a credit card. You see? And those are the important things that make you a person much higher than let me show you the house. You're in control of who they are as a person. And that's really important, people. The loyalty that it builds and the camaraderie is incredible. And then they start telling you, they start being more and more candid. So very important is Amount, the payment history, obviously, and the amount owed, you have to try and focus on revolving credit. It's where the most impact will go. Okay, so if you have a credit card and you owe 5,500 and your limit is 65, if you bring that credit card down, it's like 10 points per thousand. It's crazy what it'll do. Imagine if you do that on 2 or 3 credit cards. Okay, length of history. How long and how old is their credit? A lot of people, and this has happened to me personally, even though I meet with my buyers and I sit with them in person and I explain to them everything I could possibly think of credit, because that's my passion. More than the loan, I love credit, right? Don't close anything in the process.
Or even.
We need the length of time, and immediately when you close it, it impacts your credit. We need the length of time. Don't close it after. You have that annoying credit card, you want to get rid of that First Premier that charges you $20 every single month, all of that crazy stuff. Yes, you want to get rid of it because you're thinking you're buying your house, you want to streamline. You start closing those accounts and they no longer have an impact, and your accounts then become limited to whatever length of history is left. You don't want that. So don't close any accounts. So what are 3 things I've given you right now that you're going to talk to every borrower the moment you start with them, the moment you meet them?
The credit.
Credit app,
Keeping track of your.
keeping
credit.
track of your credit, knowing your credit, right? Knowing the amounts you owe and where your money will most impact your credit. Always revolving. Revolving wins. Revolving wins. Tell that to yourself and tell that to every borrower you talk to. And the thing is that not every realtor is going to have this dialogue with your borrowers. So you really start to set yourself apart, because we all show the same thing. We all have vanilla and chocolate ice cream, right? So it's true. Let's just, you know, be the ones with the nice toppings on top. So, and length of history. Don't close any of your accounts. Those are 3 important things that as you're developing, how much do you want to buy? How much you want to get qualified for? What house you want to live in? These are 3 things I need you to work on immediately. Download a free app. I'm not even going to tell you which one to do. And make sure that you pay down on your revolving credit and not on your loans. And the length of history, don't close anything. Keep it as long as possible. New inquiries. If you're running your credit with us, and if you ran your credit with another mortgage company within 30 days, it does not impact the score. If they ran a mortgage credit and they absolutely end up, for some reason, see a commercial about a Toyota Corolla on TV and they show up and they run their credit at a dealer, just so you know, the dealer is going to run it a gazillion times. And now you've affected the possibility of, when you're bringing down your revolving, now you have inquiries, so all of a sudden your credit score is not moving up. So make sure, no new inquiries. These are the things that are going to make you get the best possible interest rate. And right now, interest rates are a problem. So if you keep constantly telling them that you're going to try to get them a lower interest rate by doing these things, you start becoming a financial advisor as well as their realtor partner. And types of credit we determined, right? So worst credit ever is a judgment and a collection, right? Do not pay judgments or collections off. Do not. The moment you touch that, your date of last reported is going to update, and your last activity before that is going to be a negative one. So your score is going to drop by 30 to 40 points. So that's a very big myth, because how many of us don't have somebody who has some sort of medical bill and they're trying to buy their house? So the first thing they're thinking is, I'm cleaning everything up. Yo voy a limpiarlo todo. No. Tienes que hacerme caso a mí. You need to pay attention to me. Let's go ahead and not pay those things off. And if you really want to look at it, the what if can tell us. If you pay it off, you'll see that the credit drops instead of going up. Let's show them visually what an impact it has. You know, next time you see them and you're going to show them the house, imagine if you show up with a report that says, I can take your credit from 643 to 700 if you do these things in the next few days. Let me go show you the house anyways, blah, blah, blah. You know what I'm saying? Like, it starts to set you apart, and they need that information, because now if they drop you, they don't have access to what you were telling them. Okay, any questions on payment history, amount owed, length of history, new inquiries, and types of credit? Anything at all?
I just have a question about loans in regards to student loans, for instance.
Okay,
How do you manage student loans? Because I know people have a lot of questions.
that's very, 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 very important, and I did not put it in here, so I'm glad you brought it up. Student loans are looked at in two different ways. Let's start with two different ways, maybe three, but let's start with two. So, zero payment reported. We add a payment of 0.05 to everything that's zero payment reported. If they have an income-based repayment plan, right? It's looked at a little differently. If they have an income-based repayment plan. If the payment used doesn't cover the payoff of the loan, depending on the product we use, whether it's conventional or FHA, you may have to still accustom the payment or not. If they go into a normal repayment, okay, that is not forbearance in any way, we would use whatever payment is reported on the credit report. Okay, so best thing to do, and student loans are very messy on the credit report. Sometimes you'll have 9 of them, right? And like out of those 9, 5 have balances, and then you have a really big one at the bottom. No, all of those consolidated to that one, but the bureau never updated because it's so messy. So it's very important to like know their credit and say, wait a minute, you owe 98,000 over here. Did you owe 98,000 plus a 4 and a 12 and a 7? No, 98 is what I owe total. Okay, then we know that all of those consolidated. We can now make those all zero payment and give the 0.05 to only the big one. And that's it. And that requires a little bit of documentation. But if we know that when you start at pre-approval, we're not in the loan yet, right? You're still showing them houses. You're still getting them romanced. So having them fall in love with property and the opportunity of home ownership. So during that time, we can get those addressed, get the right documentation, make the right phone calls, and have it so that even if the credit report doesn't update, I can do a supplement and make it so that those payments are all zero and we only use the big one. But a lot of people in the last 2 years have that scenario where they have a big loan because everything was consolidated based on some of these programs that Biden forgiveness and so forth. And some of them got $10,000 wiped out. And it doesn't always reflect on time, you know. So anything that comes from the government, we know is a little slower to roll. So let's make sure we address it with the borrower because maybe that's bringing down their score too. It won't affect much because they're loans, but if they were all zero, you might get 4 or 5 points extra. And it might take you from a 576 to exactly your 580, you know? So important to address all of those things. So taking control of your borrower is going to equal making them download a credit app, anyone they want. Understanding that bringing down revolving credit is the most impactful, right? Length of history, do not close anything. Don't close any accounts. Don't try to open a different industry. You cannot deny them from running credit with another mortgage company to try. Not what we're here to do. We will please everybody we possibly can. The important thing is the customer and the relationship with you, right? In types of credit, understanding the difference between a loan, revolving, charge cards. Charge cards have no impact on your credit. So in American Express, 0 impact on your credit. If you owe 11,000 and it's a charge card that you pay every month, has no impact on your credit whatsoever. Only revolving. I lent you 8,000, you've only used 4. That is a big thing. But a charge card isn't really lending you. You have to pay it at the end of the 30 days. So you'll find that some people, oh crap, I just paid off my Amex. It's not going to do anything to the score. But it's also a really good trick because for 30 days, you can use your Amex, right? Since it's not going to impact your score and not use anything else you were using, not use that Capital One or anything else. So those are other things that are kind of cool little tricks of the trade. Any other questions? Anything else I can harp on regarding the credit? You guys feel good? How about online? Everybody good? You get a thumbs up? I can't see
I
everybody.
don't see any questions. I'll let you know, but so far, nothing.
Awesome. Great. Okay, and then, oh, did I go to, wait a minute, did I go?
We are on credit influence solutions.
Yes, but did I skip a slide or no? It went to- this is
Go
the
back
next-
one,
How do I go back?
and the bottom of your presentation, there should be like a little arrow or do the back arrow on the. Keyboard.
Ooh, no sé. Oh my God, I'm going further. Sorry.
Oh, I'll be there.
Wait, can I just maybe pause share? No, remote control. Auto stats, share clip. Oh. I feel so old when I get stuck in technology. It's like so bad. And then my kids are like, oh, please, with one finger. Poof. I'm like, ah.
First, let
Oh.
me hide this because this is probably what's giving you the. And then here, see a little,
Oh my God, it's like
So
right
you
now.
were here?
I wasn't even seeing.
right,
that
so
yet.
once you put your mouse there, it should come up, okay? So you're going,
This one is the next one, yes.
Yeah. and I think, if I'm not mistaken, I think you can also use your arrows. So
Oh.
that's easier, okay?
Yes, that's easier. That's perfect. Okay. So judgments, and I didn't include other words here, judgments and charge-offs. Difference are a judgment is current and live, right? They will require a payment plan for a judgment. Does not require you to pay it off. So if you have a judgment, for it to have become a judgment, that means you have owed this money for a little bit. Maybe 2-3 years, right? And they finally went and put a judgment against you. So what happens with the judgment is if it has a balance, we have to use 5%, not 0.05, 5%. It's a huge payment and it kills transactions all the time. But
So we
if
have
you
a
were-
question, Eric.
Yes,
What is the smartest way to raise your credit score if you have some extra money to pay it off? I missed this part when you were speaking about it.
okay. The revolving credit is your best bet. So to recap real quick, if you guys can bear with me, recap real quick is the moment you meet your borrower, first point of exercise is download a credit app. You need to be in control of your credit score. It is going to drive your interest rate. It is going to drive your conditions sometimes. Okay? For example, a lot of people don't know this, but there's a quiet situation that happens with people under 700 if you go conventional. Conventional under 700 requires 2 months reserves. Conventional over 700 doesn't require any reserves whatsoever. So those are things that are important. If you're at a 698, yeah, let's get you to 702 and you don't have to have that extra 8,000 in the bank after closing in order to be able to buy this house because an average mortgage payment is 4,000, right? So you're going to want them to download a credit app. You're going to want to tell them to focus their revenue, their money on not paying down additional funds on any loans. Pay down additional funds on your revolving credit. Revolving credit has the biggest impact. Okay. And then length of history. Don't close any accounts. Make sure they know that they cannot close any accounts, right? And no new inquiries. So don't run your credit on a different industry than mortgage in 30 days. Okay. So I'm going to show you the chart real quick again. It's up there. You can see 35% is payment history and 35% is amount owed. That's pretty impressive, right? So length of history is 15% and the other two are 10% each. The biggest factors here is don't pay late and make sure that if we bring anything down, we bring down your amount of revolving credit. Right? Is that answer good, or do you need a little more info? So if you do, just let me know and I'll run by it again.
Thank you. No, that seems to have answered your question.
Awesome. Do not pay off judgments. I mean, you don't want to pay them off. It'll update. What we need is the payment history. Best thing to do is we find a judgment that's active and live and currently with a balance. Encourage the borrower to call and make a payment plan. If it's a judgment, the money is lost. It's gonna go to charge off soon. If you call them and you make a payment plan, they're gonna give you like cents on the dollar. They're gonna give you like, You owe $38,000, give me $120 a month. It's much better than $1,200 a month if I have to use it, because you won't qualify with 1,200. You see? So those are really important factors. Charge-offs, don't touch them, leave them alone. A charge-off is already on its way off of liability to you. That means that the creditor has chosen relief from the debt. They're going to get a tax break, and therefore they're no longer going to pursue anything. This is why they do charge-offs, right? Any questions on that front? Other things we can do. One of you? Other things we can do is most transactions are going to have two borrowers, right? Most transactions are going to have two borrowers, husband and wife, father and a mother, a daughter, and a parent. Most transactions are going to have two borrowers. And what happens is one of them generally has better credit than the other, right? So another way we can instantly improve, and you can talk about this at the very beginning when you meet them. Again, this is like beautiful things to build the loyalty. You tell them the ability of us adding as an approved authorized cosigner to an active account of the cosigner is huge. Because the cosigner may have a Capital One card that they've had since 2005 and never paid late. Now you add this authorized user into that account, and magically we get 30, 40 points. He's an authorized user. They don't even have to give them the credit card. They can just put it so that it reports on the credit report and keep it in their house. I don't trust them with my credit. I get it. But so you need to look at the whole transaction. And that's where opportunities start to fall in place. Where another loan officer or another team might say, look, as a whole, no, I'm sorry, their scores are too low. They don't make it right now. Come back in 30 to 45 days. Tell them to pay down some of their credit cards. They're not even giving you a what if scenario or anything, which is directly correlated to their score. They're just telling you what to do. Well, if we look at the profile, there's always something you can add the co-borrower to, right? So lowering balances has a high impact. We talked about that, and the what if simulator for immediate results is what I really want to focus on. I think we should do a what if on pretty much everybody, even if they have the score. If we can take them higher, if we can show them how to get to a best possible interest rate, it's going to be incredible because nobody else is doing that. All they're doing is doing the contract and trying to get them to close really quickly. Yes.
Our cosigner and credit, it won't affect anything. If you have a loan for a property, it won't affect that to the cosign, right?
If they have a property that is their primary residence, and then they're just helping for credit purposes, that would be a non-occupant co-borrower, which is a really good thing, but they need to have enough income to pay their bills and contribute something to this transaction. And it's only 50% that we use. So the strongest co-borrower is the one that occupies with them. And if they have a property that they're departing, we would need to justify that departure. It happens where the mother's moving in with the son because she has a primary residence with the husband, but they're getting separated, and that happens. Or the other way around, or the father's leaving with the son and they're getting separated. Those situations we can address as they specifically come up. But for the most part, adding you as an authorized user to a cosigner account will not impact the cosigner negatively, and it brings up the score on the borrower. So it's really, really strong process to consistently talk to your buyers about credit and what it can do for them. Okay. So we talked about judgments, charge-offs, things of that nature. Using the co-signer's account to help. Everybody got that? Lowering balances has high impact. Let's focus on revolving when we're lowering our balances. And let's see if we can do a what if simulator and have immediate results for your buyer. Okay. So now let's talk about the ugly stuff that happens to a lot of people at some point in their life. The number's astronomical. You've either had a foreclosure event or an attempted bankruptcy or something, it's an astronomical number, like 40% of all Americans at some point run into something in this scenario, right? And everybody asks, well, I had a bankruptcy. I don't think I can qualify. I had a foreclosure. I had a situation that happened. So let's talk about FHA. A Chapter 7 is the one that you clean your hands with all your debt. Very difficult to get, but a lot of them do go through. And the judge says, yes, we will wipe you clean. You start all over again. They clean everything up, right?
What's the years of range on that?
2, that's exactly what we're gonna do. So a Chapter 7, I need 2 years. But if the Chapter 7 has a mortgage in it and there was foreclosed or short sale or something, that changes the situation. Okay, so a true bankruptcy based on I overspent, I got a luxury car, I went too much on my credit cards, and last time I went to Egypt, it was really expensive. You know, that's that one, 2 years. 2 years. So they tell you, oh, I had a bankruptcy 4 years ago. I had a bankruptcy 4 years ago. No te preocupes, we can still do it. We can still move forward. You know, download your credit app. Let's take a look at your score. That's going to be a big factor, you know, and then you go into that direction. Then you have a leniency for 1 year with extenuating circumstances. What are extenuating circumstances? You guys know that huge hurricane we had 2 years ago that just pretty much destroyed all of Tampa, and literally you can see the sand from the ocean coming in. That was crazy. That's an extenuating circumstance because the employer and the borrower both were displaced. So that's a situation where there might be, hey, I couldn't get my bills to work. The United States have recently started this whole situation where they declare it a state of emergency and they bring in federal funds, then all of a sudden you do have the ability to stop any negative reporting. You know, like you can get a forbearance, if you will, on everything because you're in that area. But let's say it's not a natural disaster. A person's in the family, there was a breadwinner, not even the primary breadwinner, passed away, a major illness, things of that nature. Divorce is not an extenuating circumstance. A lot of husbands say, oh no, because the credit was joint and I decided not to pay and blah, 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 because we were getting divorced and all that stuff. That's not an extenuating circumstance. You had an obligation, whether you're married or not, you made a promise to repay that debt. That is not an extenuating circumstance. So very important to understand that because everybody asks me, oh, because we got divorced, that's not an extenuating circumstance. But 2 years is not a lot. You kind of need 2 years to kind of get back on your feet anyway. So it's good to know that 2 years is little as that. If they have a Chapter 13, what is the difference between a 7 and a 13? Anybody know? Anybody know? Huh?
10 years perhaps?
No, the difference between a Chapter 7 and a Chapter 13 is Chapter 13, you're repaying the part of the debt. The judge said you owed $120,000. Well, where all of your creditors agreed that you're only going to owe 60 and you're going to pay $700 a month for the next 3-4 years, whatever it is. If you get a Chapter 13 and you've made 12 months of payments on your Chapter 13, you qualify. And that's huge. So many people disqualify themselves thinking, oh, I got to wait 2 years. I got to wait 3 years. I got to wait 4 years. Wait a minute. What kind of bankruptcy did you have? Huh?
So there's only 2 types, 7 and 13.
Yes. Then the other distressful thing is foreclosure, which we'll cover now as well. Okay. So Chapter 7 on VAs, Chapter 7 mirrors FHA. 2 years minimum with 12 months of extenuating circumstances. Chapter 13, minimum of 12 months with satisfactory payment history and court approval. Any questions? I'm not going to cover USDA. We don't have a lot of that in Dade County. We're not really agricultural. If you start selling up there in Central Florida, there might be some USDA options.
Do you have the locations for USDA? Because I have clients
that wants a USDA.
They want that program, but
I can
don't know
guess.
the area.
I can get you. I can get you. Yes, I can find out what areas would be designated USDA and also the size of the property. It has to be, I think, 5 acres plus, something like that, like,
Yeah,
it's,
yeah,
there's some,
right.
yeah. So I can find out what areas would work for that, yeah.
Okay.
I haven't done a USDA, no joke, in at least 7 years. And it
Yeah,
wasn't,
but some people are asking for that.
yeah.
They-
Well, and I think like in the Redlands, there might be some opportunities there. There's still some big parcels of land, but I'm not sure if it's covered in the USDA map. I'll check it out for you. Okay, so now we're gonna talk about the conventional side and how they look at things. They're a little more strict. A chapter 7 or an 11 requires 4 years. Both of those disqualify the debt completely. So these are resets, right? So the bar is starting clean, day one. And you'll find that they usually have really good credit score because everything else gets wiped out and discontinued, and everything from then is starting to become, it's starting to be like fresh credit that's never been late, right? So on conventional, you do need 4 years for bankruptcy if you want to try to do a conventional. When is this important? And I need to make sure I hammer this in for you guys as realtors as much as possible, is in condos. Because condos have to be conventional financing. There's very, very few properties that are FHA approved. Why am I saying that? Because on single family, every time you send it to a listing agent that says, I know, but can they do conventional? I don't understand why it matters to the seller. It shouldn't matter to the seller. First of all, let's call it like it is. FHA, it's easier to get approved. Your FHA buyer is more likely to close than conventional. Conventional, anything can throw it away. Anything throughout the. So what is it? Why are you giving me beef? Unless it's a property condition. They have chip paint, they got a couple things or whatever. And then the negotiation in that sense is, what can we do to overcome that to get into the closing? Because maybe the borrower has no problem with the fact that the roof is expired and they're gonna do the roof the moment they move in.
But that's the listing agent.
Exactly, but that's where you need to
to be-
slowly kind of like break it in. Listen, why don't we work together? Let me go over there and see where the chip paint is that you're telling me is wrong, or where the roof is kind of leakish or whatever. A lot of those things, I can take the borrower to closing with an inspection saying that, you know, it's that you can get an inspection based on the work starting, and you give a deposit and everything, and they'll give you an inspection with a clear. So a lot of things we can cure. If it's an appraised value issue, that you do have a problem with.
Yeah.
This is what I mean about that, okay? FHA locks the value of the house for 6 months. So when you go to do a property, FHA orders a case number. That property is now in their system. And if we do an appraisal, it is reported back to them. And when it's reported back to them, the price is locked for 6 months.
If it's
So-
lower, that affects-
Huh?
If it's lower.
And if it's lower for 6 months, they can't sell it FHA because that's the appraised value that every appraiser has to get. So that's where you run into a situation. So you ask them, have they done an appraisal? Is that what's holding you back? Because if it's property conditions, guys, try to overcome the property conditions. Like, it's Miami, we all have property conditions. There's no situation where it's not gonna be a problem. Like, you have newer homes that have indications of stuff, you know?
After the listing agents, it's good to have a appraisal before to put the price of the house, right?
You could do that.
The owner, you know.
You could do that. Yeah, yeah. You
You
could do that, or. You know, the thing is, if it's not property, if it's appraisal value, you run into that situation, but who knows, maybe knowing, hey, look, if they tell you flat out, no, I don't want you to do an appraisal because it came $10,000 short. What if your buyer is willing to pay the extra 10? But they only qualify for FHA. See, but if you don't have the conversation, somebody else is gonna get it. Somebody else is gonna get that chispa. And because they asked that question, you know? And there's always a mother or father or somebody in the family que está tratando de ayudar a su hija, so eso, te voy a dar un poquito, te voy a dar 5, y el otro le da 10, y ya pagan los días por encima. So be candid. Why is it you don't want FHA? Because I know that it's easier to qualify. So it's not the buyer closing. Is it the property? property condition, property appraisal. Which one of the property issues? Very important. So continuing on the credit portions, chapter 7 and 11. So 4 years from discharge, dismissal date, 2 years with extenuating circumstances. So this is double FHA all the way around. So you need 4 years. And if you want to do extenuating circumstance, somebody passed away, there was something I couldn't control, things of that nature. I myself was in a destructive accident, God forbid, and I'm fine now, but it took me 9 months to get to therapy. Things happen. Then in that situation, you would need 2 years in order to go of extenuating circumstance. But again, the main focus here would be only if the person can only buy a condo. Because let's try to get them into an FHA. It's easier, the DTI is higher, they have less requirement. It's just FHA, if you check the boxes, they have to lend to you. That's why it's very powerful. Chapter 13, 2 years from discharge date or 4 years from dismissal date. So you don't get leniency on payment history on convention for chapter 13, like you do on FHA. If you've been paying it for 12 months, you can be in chapter 13. I'll still do your loan. You can't do that with conventional. Okay, it has to be 2 years from discharge date or 4 years from dismissal date. More than one bankruptcy within the past 7 years, 5 years. If you've had more than one bankruptcy in the past, you're not good at financing stuff, but things do happen and there are situations that are valid. So 5 years from the most recent dismissal or discharge date. This is a very, very cool sheet for you to have. I would recommend you have this on your phone, saved on your wallpaper, so that you could have it and show it to them the moment you meet with your borrowers and they tell you about bankruptcy. I would necessarily not send it to them. Let you be the resource. I mean, if they absolutely have to show it to them, ay, mándame eso, está bien, but you can use it as a reference. Let them always come to you with that kind of stuff, because that's what you're going to build when you tell them, get your credit app, pay down on your revolving. Let's see your bankruptcy. Is it a 7, a chapter 13, and 11? Are you trying to do conventional, FHA? I'm telling you, it's completely different way of working. Does anybody have any questions regarding the waiting periods? Ooh, almost an hour. Okay, I'll try to wrap up in the next 5 minutes. No questions regarding the waiting periods? We're all good?
I don't see any questions so far. Remember, if you want to have ask a question, you can unmute yourself or type it in the chat.
Nice. Okay, so next. Foreclosures. This is the ugly one, right? Luckily, foreclosures in the last 3 years are almost non-existent because appreciation of value has been steadily rising. So people run into financial trouble, they still have a little bit of equity and they're able to sell. So foreclosures are very limited now, but they are a big part of the business. So understanding if you've had a foreclosure, let's look at how the different agencies would collaborate with you. So foreclosure on an FHA is 3 years, not 4. Very important. Everybody makes that mistake. You have no idea how many buyers I've gotten because somebody else has told them that the discharge date is not expired. It's not true. It's 3 years, not 4. That's important to know the differences. 12 months with documented acceptable extenuating circumstances. Think about that. You could have lost your house last year, but if it was an extenuating circumstance, I could still lend you on an FHA. Okay? People don't know that. That's why it's important to push and ask those questions. And when you're converting, why are you renting? I had a foreclosure. I can't afford to buy. Rates are too high. Well, let me work on getting your score up so I can get you the lowest possible rate. VA, 2 years. The veterans have it good. So if they've had a foreclosure, 2 years, they can get a loan, 12 months with extenuating circumstances. And if they have their entitlement, they can do this with 100% financing. And if they have the score, they can do it with 100% financing and get the help. which means they buy the house with no money. VA can buy with very little to no money.
No money, that down payment, but the closing cost,
And the closing costs, what if I get the down payment assistance? Then you got nothing. $550 for an appraisal and you're done. That is crazy. We should all be finding ways to tap into veterans. There's an organization called VA Rep for Realtors. You should all join. You should all be constantly talking about veterans. You should have stuff that says veterans, I can help. And just talk to veterans. Because man, they can buy with little. VA Rep.
VA,
VA and then REP.
IP.
No, REP. VAREP. It's a great organization. They meet weekly, they appoint people, all of that, and it's a way for you to be able to advertise veteran stuff. And I have a lot of veteran flyers and stuff that I can put your picture on it along with ours, and you can put it on social media too, to see if you can get bites, because you don't have to do them necessarily only here. There's Broward all the way down to Monroe, and veterans also, the DTI has got very little limit. So the income is not a problem
They
for
don't
veterans.
pay,
They don't pay,
foundation insurance.
they don't pay mortgage insurance, and if they happen to have disability designation, they don't pay property taxes. It's incredible. It's incredible to work with veterans, and they deserve it.
But the property has to qualify for VA, because I see some of the, remarks that it say VA, or doesn't have to.
It doesn't have to say VA on the qualification. If you see that it says FHA, it qualifies for VA. It's Ginny, you know, if it qualifies for one, it should qualify for the other. They don't want veterans buying a property categorized as a dump either. You know, there's a grade that happens, and nobody knows this, but every single appraisal has a grade for the property. It actually grades the property like an ABC type of grading. If it's a poor grading, it's going to be a problem for a veteran, because they don't want to put a veteran into a problem. Okay, so property condition, just again, visit the property,
Yeah.
you know, and explore the possibility of why they're telling you no. So very important. 3 years, 2 years. Fannie Mae, 7 years. 7 years if you had a foreclosure to get a conventional loan. And there is very little exception. To get an extenuating circumstance done is possible. That would take 3 years. 3 years. Foreclosure and bankruptcy. Apply BK waiting period if the documentation verifies the mortgage discharge in the bankruptcy. What does that mean? That means that I can go back, and if the mortgage was discharged inside the bankruptcy, I now only have to wait 4 years. I go back to the bankruptcy waiting period because it was all covered in there. Does that make sense? So let's talk, any other questions regarding credit? Because I'm pretty much tapped out on that subject. I think we covered everything we possibly could. Any other questions about credit that I can help you guys with? If you have any borrowers that you have scenarios you would like to run or anything at all, just let me know. I'm here to help. And I really love credit, and I love working with people and fixing it and getting them on their mission. I mean, historically, I've done very little marketing. I've always just worked really hard with the borrowers and their credit. And I would say still to this day, 70% of my business is brothers, cousins, and sisters that come back because of the impact that I had on them being homeowners. Right? So a good way to rebuttal interest rate is let's get your credit score up. And that starts you into the conversation about credit. But if we have no more credit questions, I just got a couple little subjects that I want to spitball to you guys that are very exciting, and then we can wrap up. Okay. So gift funds now permitted on investment property. Why is this important? Because up until now, it is not allowed. The investor has to have 100% of the money and reserves to qualify as an investment property. Now they can get a gift. How does this benefit? Well, you have somebody who's trying to buy a property with somebody else as an investment. They want to invest together, but their score for investment properties is very strict. It's 680 or better. So you need to be a really good financially savvy person to get an investment property. But you have somebody else that's doesn't have the 680 but wants to do the investment with you. If they are a relative, they can now give the gift. So you can still kind of do a transaction if you don't have all the money, because the money must be in the borrower's account, reserves plus everything else. This is a huge change. I have never seen it in my entire career until now. So I'm very excited because I am going to use this myself to purchase an investment property. My mom gave me the gift and I'm going to use my credit and buy that property, you know? So very, very cool stuff. The credit is as low as 680. And the borrower can qualify using the DSCR program. So think about that. If you have the credit score, you no longer have to worry about your income to buy an investment property, right? And you can get a gift for the money. So it really opens up. I think all of you should post it today. By the way, if you're looking to buy an investment property, now you can get a gift from a donor. Call me for more information. You guys should all be posting that. It's really exciting, and trust me, there's a ton of people that come to me to try to buy an investment property and they just don't have the 20% plus the reserves and they can't do it. And they still want it. So any questions about the new investment upgrades? Okay. DSCR is debt service. Debt service, oh my God. Debt service loans, yeah, but debt service. I'm not 100% sure what the C and the R is, but basically what it means is that as long as the property pays for itself.
It says it's debt service coverage ratio.
Exactly, debt service coverage ratio. Thank you, Hanai.
Google's your friend.
Hey. No, that's great. I appreciate it. Thank you for that save. Coverage ratio. So if the property covers itself, if you can rent it for 4,500 and the payment is 4,420, you're borrower qualified and you don't got to verify anything. You don't put in your income, employment, nothing, just credit, run the credit score, and that's it.
That's the program that is, I have my own house and I wanna buy for rented house. Is that the program?
Yes, exactly.
With a 5% or not?
No. Debt service is only if it's a true investment. What you're talking about is if you own your property and you want to buy another one and rent yours out, not the one you're going to buy. If you're going to rent the one you're going to buy, it's always an investment.
It's an, yeah.
What is the name of the program?
Debt service coverage ratio.
Yes.
But the borrower has no income. They don't even put an employer. So nothing, just run the credit, put the assets,
Yeah,
and they
because
qualify.
that you're gonna rent the house for the amount of money.
Exactly. And who determines the rental, guys? It's the appraiser.
Yeah.
The appraisal will come in and tell us the range is this. We get it rented for that, and that's it.
And they're
You're-
gonna know how much.
And they know how much it qualifies for. No, it's such a simple transaction.
But it's that you say, it's not, we don't have the money.
Now you can get a
pay
gift.
it.
Now you can get a gift.
What is the down payment in that program?
20% is the minimum.
It's high.
It is.
Yeah.
Investment
Well,
properties,
And you have to have, una cantidad en el banco.
you have to have reserves of 4 to 6 months, depending on your score. From 680 over 700, you can have less. So that's also a ton of money
Less than
because your
1 year?
payment, huh?
Less than 1 year of.
6 months.
4 to 6 months, yeah.
Oh, that is not.
It's not terrible, but it is a lot. Porque los pagos ahora están en 4,000 y pico de dólares. Le mete, that's another 25, aparte que tuviste que dar el 20 y los gastos de cierre.
Yeah, it's.
Ahí sí no hay ayuda. There's no help. There's no DPA for investment property. We're not helping the investors buy properties, you know? So keep that in mind. So no, any other questions on this part? Let's see. Okay, Hometown Hero, some updates. Let's do this. This is exciting, guys. Really exciting part. No longer an occupation requirement. That's it, July 1st. So you can start selling because all I have to do, I don't have to originate the loan after July. I can start the loan today. As long as we close after July 1st, you can already use the program. We will take it in. Okay? So very important, no longer an occupation requirement. They don't have to be a firefighter. They don't have to be a nurse. They don't have to be a teacher. They don't have to have anything. Right?
Wow. Any work,
Any-
But it's not an occupation requirement, it's for investment, so.
No.
that's hero.
The Hometown Heroes, we already left investment. This is the down payment assistance.
But it's not required occupation, you can rent the property.
No. This is the down payment assistance. This is not,
Occupation.
this is not the investment thing. The investment we already left behind. This is Hometown Heroes. Now we're talking about the DPA. So no occupation requirement. In other words, they don't have to be a nurse. They don't have to be a firefighter, not to be anything. They qualify, yeah, and I can start the loan already as long as I don't deliver it until after July 1st, which we won't. We're good because we're already in June.
Like
So-
a self-employed,
Self-employed, yeah, that works. Self-employed in anything. I could be a truck driver now. I could be a bus driver. I could be anything, and we can get it going. So it's really huge. However, some of the things have now changed where they must work a minimum of 35 hours a week. If they work less than 35 hours a week, they will no longer qualify for the DPA. So very good conversation to have when you meet them. If they're going to use the down payment assistance, make sure you work your 40 hours. Please don't be like sick or anything for the next month. So we can have a whole month of pay stubs. And then we don't have to worry, because once we verify the month, we no longer have to worry. So let's just please try and get everybody to stay at their job 35 or more hours. Very important. Okay. Employer must be a Florida-based company. That can be a problem, because some companies are actually based out of Florida. So if the borrower is working here and the company does not have a brick and mortar location in the state of Florida, they will not qualify. But that's not very common for Dade County people. We're so far south that most places down here are from either Florida or local businesses, you know?
Like,
Or they have a brick and mortar. Amazon has a brick and mortar. They have one in Homestead, a huge one, you know,
The hospital Baptist.
everywhere,
Yeah,
everywhere, exactly.
it doesn't, because I have a person that she's not a nurse,
Right.
but she wants to apply, but now.
Now you can, and it gets even better. So employer based in Florida. Self-employed buyers must have a company on Sunbist or provide a 1099. Which is easy, not a big problem. Right? Now the assistance is $35,000. No longer 25. It's still capped at the 5% of your purchase price. So it's one or the other. And that's what they didn't put here. So
Like if it's 700.
seven, exactly. Then you get the 35. Yes. Okay. So maximum assistance increased to 35,000. That is huge. That can cover almost all of your borrower's closing costs, if not all of it. And that means your borrower is really buying with 3%, whatever that 3% is. In some cases, because this program also has no origination fee, which others do, and you don't pay transfer taxes. So it really becomes like a $40,000 benefit to use the program, because every transaction requires transfer taxes, right? So it's a very big deal. You can get a borrower in with very little money. I'm talking less than 10 grand, any house they can buy. So
I have somebody
good.
asking, I'm sorry, let me see, is the 35 now or in July?
July 1st. This is all, guys, all of this is as of July 1st. However, we can already take all of this into account, originate a loan and start it. We just cannot close. All they want is for the fundings to begin after July 1st, but you can already hit the road. Okay. New income limits. This is huge. We can now go to 154,800, so you can now qualify for a $700,000 property.
Well,
Yes, 154 will pay for a $700,000 property.
they don't have a need.
Not a lot of debt. But most people that are buying 700 and something, it's not the same buyer as a $350,000, $400,000 buyer. They have a,
How much is
a stronger
the
source of
mortgage?
income, huh? What?
How much is the mortgage?
About 5,000, Yeah.
Well, it's so much.
about 5,000.
But if they have that amount, they may.
But if they qualify, they qualify. If they qualify, it's not that much because they qualify.
Well, it depends how much they want to spend every month to pay the mortgage.
Right, but 2 + 2 is always 4. This isn't 2007 when people were buying $1 million house and paying $1,000 a month because they did a pick a pay. You know, if you're buying a $700,000 house, because every time you click on Zillow, it tells you this one is 5,420. This one is 5,120. Like everybody's educated now. They know that a $700,000 house is going to be 4,800 to 5,200. That's the house they want. And it's not expensive because the average person in Dade County makes an average, like that has a corporate job, 60 to 70,000. That means that each one of them can pay $2,500 a month.
When you tell people that they.
So that's the truth. You're buying, not a lot of people buy by themselves.
Yeah.
Not a lot of people do. And then when you get into those price points, you can also roll in. Maybe the son is going to live with them for a couple of years. They can help qualify, things of that nature, And remember, if you put in the son, if he doesn't have a primary residence separate, he can be in there as a non-occupant co-borrower, helping the borrower and still qualify for DPA when he goes to buy a house. Because he was never a homeowner. He was never on title. Very, very important fact.
Yeah, because some kids, doesn't want to be helping their parents.
Because they want to buy soon.
They want to buy the.
Now you rebuttal that, like, don't worry, I can put you as a non-occupant co-borrower. You're not on title, and therefore you qualify for DPA when you go to buy your house. Okay, so first-time home buyers, the only one who has an exception to first-time home buyer is if you buy what do they call it? There's certain areas in Dade County that are not, that you don't require to be a first-time home buyer because they're lower income and they're putting financial focus in those neighborhoods to bring them up. They're kind of hard to find because they're by track code, so you can always check. The other person that doesn't have to worry about being a first-time home buyer ever is a veteran. The veteran doesn't have to worry about that. He can always get the help.
They deserve it.
They deserve it. And the reason why the lights are on.
Or,
Thank you all for your service.
or after 3 years,
Sorry?
or when.
Or after 3 years, yes. And how do we verify that now? Through taxes. So the only bad thing about the change is that they now require 3 years taxes. So I can no longer use only 1 year on self-employed to make the income really high. I have to use the 2 years because I'm going to show it. And if you show it to an underwriter, they have to average the income. So hopefully, your buyer has had good income the last 2 years, or at least, generally, because you have to average it. Now I have to submit taxes in order to prove occupancy. Okay, to prove that they never had ownership. But a lot of exciting stuff. Anybody got any questions about Hometown Heroes updates? And please start promoting it today. Let them know. I would say on your social media, coming June 1st, huge changes to the Hometown Heroes program. And, start putting one of these lines one by one, like post today, no longer occupation requirement. Call me to find out. Then, 2 days from now, put the buyer must work at least employer must be based in a Florida company. Do you work for a Florida company? Find out how to get $35,000. Do the last one and maximum assistance. Hometown Heroes is going to be $35,000. Call me to find out more, but don't do it all in one. Do one, do another one Thursday, do another one next week. Use each one of these lines as a conversational piece.
Yeah, like a no longer operational required, explain that. Right?
Exactly, exactly, and then let that be. And then 2 or 3 days later, assistance is at $35,000. Exciting. You call me to find out more. Free money screens. Free money screens. So let's talk about it. It's not free money. I take that back. It's caveat. You do have to pay it back after 30 years, but But you have no payment and no interest during that time.
But they know that it's not a free money, they.
Yeah.
It's our job to explain them.
Exactly, that it's after 30 years, they would have to start paying that loan, but at zero interest.
Yeah, if you don't have that money,
And let's face it, in 30 years, eso 35,000 is gonna be like $350.
Always gonna be 35,000 or?
My parents bought their house in 1984 for $64,000. $64,000, which at that time was like, they were struggling horribly to make the payment. It was so expensive. Oh my God, a house over 50 was incredible in 1983. Now the house is worth borderlining $1 million. So you can see that $35,000 in 30 years, no hace nada. No hace nada, hace $350.
yeah,
Ya lo liquida.
Eric, Lucy wants to know if you can go over the occupation again.
Yes, the occupation, right now, Hometown Heroes requires you to be a certified Florida representative of your industry. So you have to either be a nurse, a police officer, a firefighter, something of that nature. But come July 1st, anybody, a bus driver, an accountant,
Self-employer,
an IT person, how many people with IT self-employed? Yes,
secretary.
secretary. You know who's
The office and the warehouses,
but it has.
everybody qualified.
yes, everybody.
We have Florida-based company.
Yes, so IT companies, IT people have a lot of problems getting help because of their field. There's just nothing for them. And they qualify beautifully. All IT people, very few of them are self-employed. They all have great jobs at a company that you verify instantly and you're done. So really easy stuff, guys. So no more occupational requirement. They don't have to be certified in the state of Florida to do their job. All they need is to work for a Florida company, whether it's theirs or someone else. And if it's not a Florida-based company, the company must have a brick and mortar anywhere in Florida. Does not have to be Dade County. So if they have a brick and mortar in Tallahassee, that's good. It's still Florida and it still works. Okay. Anything else I can talk about this exciting stuff? What I'm going to do is I'm going to have Hani distribute this PowerPoint to all of you via email, and you guys can review it. Feel free to call me with any questions, and more importantly, scenarios. You know, we really would love to work with your buyers, and we would love to work with you and try to help grow what you do. It's a really compressive market right now. And the most thing that we're finding is that converting tenants into homeowners is our biggest opportunity. So we must find a way to pursue that through social media, through buildings that we know are rentals, things of that nature, and just explain like home ownership, at least for right now, and this does not always happen, at least for right now, is very inexpensive to get in, right? And let's talk about interest rate, which is a rebuttal. Everybody hears about interest rates being so high. Yes, but what happens if you own the property now? Don't think about the next 30 years. Think about the next 2 to 3 years. When rates come back down, you're locked in at the price you paid for your house. And now your payment will come down instead of up at a time where you're making more money. The average American makes 2.5% to 5% more a year. So in 2 to 3 years, when interest rates come down, you're going to be in a super comfortable position. And home ownership requires a little bit of sacrifice. So get in, buckle down, have your rights, be a homeowner. That is really the message. And if you can convert tenants into homeowners, you will expand your market a little bit. And we need to expand the market. The buyer pool is very dry, and that's the truth. It used to be only inventory. Now it's honestly, calls are not coming in either. You know, not a lot of people are looking to buy in this market. So let's try to convert the ones that are already paying $4,000 to a landlord. You know? So that's all I think I had. If you have Q&A session, if you guys have any questions, I'd love to answer them. Nope, all good? Well, I look forward to speaking with each and every one of you. I'm going to get a list from Hani on who was online, and I'll try to reach out to you guys individually one by one if you have any questions. And if we can set a time to talk about scenarios and things that work for you or anything that we can do together. My team is composed of me, Jose Icaza, and Martez Hester. So as a team, we are here to support you for open houses, for promoting products, promoting social media, or anything else that can get you guys talking about exciting things and not talking about the same message. Oh my God, rates are high and properties are high. Let's talk about exciting things. And you know who you can get excited? Somebody who does not own. So let's get tenants involved. So I look forward to speaking with each and every one of you. Have a great rest of your day, and thank you for your time today. I really do appreciate it.